This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Now let's get to that chart deck. Listeners, you're going to find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Rory's picture saying looking for the downloads. As always, Eric, let's start with the crude oil chart and the EIA inventory.
EIA printed a drawdown of 3.4 million barrels of crude oil, Cushing, Oklahoma drawing down 1.1 million barrels, gasoline drawing down 3.7 million barrels. Distillates was the lone build on the board, building 1.5 million barrels. U.S. production holding steady at 13.3 million barrels. That is the plateau that we've seen for quite a few weeks now. The chart was looking awful, breaking down and closing well below its 200-day moving average. Looked like it might be headed back into the 60s, but hey, a little war here and there will change things pretty darn quickly in the crude oil market. So needless to say, this big recovery that we've seen in the last day or two has been driven by geopolitical escalation. Where the market goes from here will depend on the news flow, but my view here, and I admit that I've been wrong, or certainly early in the past, is I really think that this Israel-Gaza conflict has the potential to get a whole lot bigger from here. If we really get into outright war, U.S. defends Israel against Iran, eventually U.S. is striking Iran, Iran is striking U.S., potentially that would pull Russia as Iran's ally into a position of directly facing the U.S. And yes, I'll say the bold thing, I don't think it's at all out of the question that this eventually escalates either in the Gaza theater or into the Russia-Ukraine theater into at least a tactical nuclear weapon being detonated. And that would be a really big deal. How it would affect markets and how it would affect, for among other things, the uranium market is anyone's guess. But I really do think that we're facing a pretty bad situation here.
Yeah, certainly the geopolitical escalation fueled that, as well as inventory numbers, creating a little bit of a bounce in crude oil. But on page 2, I have that chart. And what I wanted to highlight was that there's this very large pennant that has been forming for close to a year. And when you take the highs and the lows of that fourth quarter of last year, $80 is the midpoint. And we're pretty much trading right into the $80 level. It really just shows how tightly wound up the oil market has been in this massive range. And while we identify these short-term bullish and bearish impulses over several weeks, this really has been winding up for what could inevitably be a very big move, but we're right in the dead center of that range, and the market hasn't shown its hand. This is an area where the oil markets are very neutral and could be range bound, like the interview was suggesting for at least some of the short term. But what I find particularly interesting is in the sector rotation in the whole market, the energy stocks have actually surprisingly been doing pretty well, considering oil's been weak over the last several weeks. Oil's energy names anyway have been working their way higher, and it'll be interesting to see whether the energy stocks can march to the beat of their own drum, or whether they're going to be pinned to oil from this point moving forward. Nonetheless, I want to move on to the S&P 500 and get Nick involved in this conversation. Nick, let's start off just with the S&P. What are the technical levels you're watching?
Yeah, Patrick. So right now, spot price on SPX is approximately 55.20. We have an implied move for the August 16th monthly OPEX of plus minus 130 points. Therefore, the upper implied move is 56.50 and the lower implied move is 53.90. Right now, we have key resistance at all-time highs at 56.70 and key support just below at 5,500. I'm inclined to think we see a move a bit higher right now until we test out that perhaps all-time high level. I do still think we tag that 5,300 mark before the end of September or so.
Well, what's interesting here, Nick, is that the rally that happened on Wednesday was not spurred by the FOMC. It actually almost was over by the time the FOMC meeting was on there, and it certainly wasn't triggered by Microsoft's earnings. It was some form of a short squeeze from what the S&P was a very oversold market here. Essentially, that 300-point drop throughout July has spurred this reactionary bounce. Often during corrections and bear markets, the rallies are very intense and sharp. And this is why I want to initially be a little bit skeptical. This 5,600 area on the S&P futures, I have the 4-hour chart here on page 3, is the 61.8 retrace area of the sell-off. And if this market in any way fails to beat 5,600 on the upside and follow through, that leaves the window actually on the very short term for this to break down. The downside target would be down to about 5,300, leaving the window open for about a 300-point drop. Clearly, we have some big things coming out. We still don't know the earnings from Apple and Amazon, and we have the jobs numbers coming out on Friday, all which offer the catalyst for potentially either a breakout above 5,600 and or a failure at this point. And so it's interesting that we're trading right at this key pivot, and I think the news is going to decide it. If it does, 300 points of downside toward 5,300 is definitely the logical downside target. I want to move on though to talk about the Russell on page 4. And I know that you've been bullish the Russell, and well, it is a bullish chart, right? It's been holding up along its highs. It hasn't really corrected during the period when the S&P was correcting on the downside. The one thing in my mind, though, is that I think that at this stage, the Russell could still potentially outperform the Nasdaq in some form of a further rotation. But whether the Russell has the gas in the tank to punch 2,400 on the upside for the next impulse will have a lot to do with whether both the Nasdaq and the S&P continue to rise and beat their key technical levels. I think there will be correlation in all these indices, but it's possible in my mind that Russell outperforms. Well, is that still your conviction here, Nick?
Yeah, I'm still thinking we see all-time highs on the Russell over the next couple of months. Again, outperformance over tech right now is what I'm looking at. I was kind of pair trading the small caps long and with large caps short, and thus far that's been a pretty good trade overall. Butterfly spreads have been really, really nice about a month out when trading these names. Like, for example, if you take a butterfly spread with a middle strike at the all-time highs on the Russell, you get pretty good asymmetry of risk overall. And the opposite effect with the Qs, from the all-time highs, taking, a 20 point out of the money butterfly put spread. I had one a couple of weeks ago and it went from $1.60 or so to $6. And that was a pretty nice move overall. A nice little hedge, so to speak, in the markets right now. So.
Well, let's move on to the Nasdaq. Clearly, a very big up day on Wednesday, but it still is only like at its 38% retracement of that decline and trading pretty much right at its 50-day moving average. What are the levels you're watching on the Qs?
So right now, spot price on Qs is approximately 473, and we have an implied move for the August 16th monthly OPEX of plus minus 13 points. Therefore, the upper implied move is 486, and the lower implied move is 460, right at that support area. Right now, we have Q resistance at all-time highs at 504, and I'm inclined to think we see perhaps a bit of stagnation in the Qs. But again, with Apple and Amazon reporting, it's anyone's guess. If Apple and Amazon outperform, it's possible we're back at all-time highs in the next couple of weeks, or it's possible we're back at lows again within the next couple of days.
All right, well, let's move on to the volatility index. And what we continue to see is elevated levels of volatility. I mean, we spent pretty much almost the entire year pinned in the 12 to 15 vol handle range beyond just a quick little April pop above. And here we are consolidating well above that 15 handle. And it continues to imply some wider ranges in the market and certainly is not yet signaling that some new bull market has begun, which usually sees this vol massively retrace. What are the vol levels telling you, and what are you thinking?
So right now with the VIX at a 16 handle or so, we can expect to see top to bottom intraday moves of about 1% on SPX. Insurance isn't as pricey as it was last week, but it is still more expensive than it was a couple of weeks ago. That being said, with the election coming up in a couple of months, I think it's important to look at hedging portfolios that are heavily correlated to the S&P 500 and using, butterfly put spreads, for example, that are very, very wide and out of the money, or put spreads is a very good way to capture some of that downside risk without expending a lot of premium overall.
All right. Well, I want to move on to the US dollar, which actually continues to be quite range bound. So I wanted to focus specifically on the US dollar yen. Clearly, a hawkish Bank of Japan came out trying to defend the yen. And what a move it's been with that US dollar yen moving over 1,000 pips in just a few weeks. And really a potential trend shift. We're right now approaching a trend line that is just connecting all the previous lows and a Fibonacci zone. This is obviously a place where some very oversold short-term price action could result in just a reactionary bounce. But the bigger question is that even if we did see a bounce back to 152 or 155, is that simply just it retracing a little bit before resuming what is potentially a new established trend? The yen has been in a 3-year bear market, and if some catalyst like this has turned the trend, this could be a bigger long-term trade that really establishes a new trend. And it's interesting because the currency markets generally have been very pinned and there hasn't been a lot of action. And so the fact that we can have a big move in a currency like this is waking up the Forex markets.
Now moving on to page 8, we have that gold chart. What are your thoughts here, guys?
The front month futures price appears to be up huge this week, way over $100 up from last week's podcast. But actually, more than $50 of that big move is actually just the roll premium, or what some people call the contango yield capture, on the August to December contract roll. Tape indications clearly say that this correction is over and that we're headed back toward new all-time highs. But clearly, the Israel-Iran-Hamas escalation this week has been a big driver of this reversal. So I suppose in theory it's still plausible, although I would say very unlikely, that the market could still grind lower if the geopolitical situation abates abruptly. Now, exactly how the situation would abate abruptly, given what looks to me like a extreme and rapidly escalating conflict between Iran and Israel with U.S. participation, how that blows over, it beats me. But I think that's what it would take to get us back down to the June lows on gold. But there's no reason to expect that to happen.
Well, certainly precious metals have had some volatility here on the short term, but when you really step back here, Eric, and look at this gold chart, it still has all of the bullish characteristics technically. It's holding above its moving averages. The pattern of higher highs and higher lows is persistent, and certainly with the fact that gold has worked its way right back towards its July high is an indication that the buying pressure is still there. This is a chart that could potentially still break out. If we gain any upside momentum at new highs, 2,700 is the measured targets on the upside. So watching closely here whether or not the bulls can follow through is going to be an opportunity for a potential new bull trend.
Moving on to page 9. Eric, what's the update on uranium?
Our good friend Justin Hune over at UraniumInsider.com heard my commentary in last week's podcast and reached out to me. That led to an exchange of several emails. Justin's view is actually a little bit closer to my own than I realized. Justin sees uranium and uranium miners as a screaming buy here by any reasonable fundamental and technical analysis of the uranium market by itself. Now, from a seasonality and fundamental driver perspective, the upcoming World Nuclear Association conference in London in September, which both Justin and I will be attending, by the way, has in the past often been a bullish catalyst. Similarly, last year, the market was flat to down for more than half the year. Everybody was saying exactly what we're saying now. Boy, is this thing over? Is it done? It must be all over. Then the big rally started on August 18th of 2023 and carried the URNM ETF more than 50% higher in the next 6 months. while many of the stocks on Uranium Insider's focus list performed even better than that. So the argument that last week may have marked the bottom of this market is quite strong, and I definitely want to credit Justin, not just for calling it after the fact like everybody else does, but Justin's been telling us subscribers, I think the market's about to bottom, it's coming. He's been saying that for the last couple of weeks. Last week he said, I think it's this week. Now he's saying he thinks it's probably behind us. I think he's probably got it right. Looks to me like we may have put in a bottom there, but this sector is famously volatile and has massive retail participation. And Justin agreed with me that if we saw a broad market risk-off event, that could easily lead to an even bigger sell-off in the uranium miners. Not because it makes any sense, but just because we got so many retail guys that are just wound up with leverage and margin and so forth. If they're forced to unwind, it's going to get ugly and it's going to happen quickly. Now, beyond a broad market sell-off, the only catalyst I can think of to drive uranium and uranium miners substantively lower from here would be another nuclear power plant accident like 3 Mile Island or Fukushima. Now, if you're worried about containing the risk of a broad market sell-off, the safety trade, I think, there is out of mining shares and into SPUT, the actual physical uranium. I don't think SPUT would go down on a percentage basis nearly as much as the more speculative shares. But that also means missing out on the greater upside potential of the mining shares if it turns out that last week really was the low on this correction, or the bottom of this correction, I should say. The other risk to consider is that it's entirely plausible that the present geopolitical escalation leads to the detonation of a tactical nuclear weapon. Now, that's never happened before, so we have no historical precedent to refer to. But my opinion is that any nuclear weapon detonation is likely to lead to renewed and substantial public skepticism of nuclear energy. Now, that makes absolutely no logical sense. It's irrational, it's unjustified, and nonsensical. But that's what tends to happen in the nuclear industry when you have some kind of safety event. And certainly a nuclear warhead, even though it really doesn't have much to do with nuclear energy, would probably get the public freaked out about anything that has nuclear in its name.
Yeah, Eric, I don't see any reason why the bigger uranium bull market is over. This entire pullback has been like a half a year consolidation and certainly created some short-term volatility. But this will probably all prevail as a big buy on dip. The big question, of course, is where is the change in trend? Now, we had the spot prices of uranium upticking today. It's been weeks since we saw an uptick on spot prices. And so there is certainly some indications of turning, but it's incredibly premature. I'll be looking for that Sprott Physical Trust to be clearing its June and July highs before we can really start to say that the price action is starting to show accumulation and a shift in trend. So a lot of work for the bulls up ahead. The last thing I wanted to touch on is the 10-year Treasury yield. And what's interesting is while we haven't made it all the way back to the December last year and January lows on yields, we're basically near 5-6 month lows, and certainly looks like the yields are heading down there. Bonds have been a great safe haven during this correction, and certainly now that the central bank has indicated lower rates, money flow into Treasury is happening. It's happening right across the board at all levels of duration, and certainly the jobs numbers can play an impact on the next short-term trend, but certainly Treasury yields heading lower seems like the path of least resistance. I don't see any reason why we're not retesting those December, January lows at some point in the next couple months.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly research roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.